If this is the start of a crash, this is how Goldman is trading it. By Tyler Durden. Wednesday, August 7, 2024, 8:20 p.m. Goldman sell-side research desk has traditionally been one of the most bullish on Wall Street, usually to the point of comedic and mind-numbing obstinacy, refusing to cut their cheerful economic outlook until the U.S. is deep in a recession. Which is why we note today's decision by chief economist Jan Hatzius to hike his 12-month ahead recession probability from 10% to 25%, full note here, as a flashing red warning for the simple reason that by the time Goldman raises this subjective indicator even a tiny bit from its resting baseline, the wheels are already falling off, if not the economy then certainly the market. And indeed, as shown below, the last time Goldman hiked recession odds from the 15% baseline back in July 2022, the market proceeded to crater into the worst bear market since COVID. Which is why we were very surprised to read a note published by the bank's thematic desk this afternoon pitching the bank's first short trade reco in a long time, one which, when reading between the lines, is what Goldman is telling its top clients is the best way to hedge a potential crash. As Goldman's head of thematic Lewis Miller writes, given the drawdown and uncertainty around AI, and uncertainty on 1. Geopolitics, 2. U.S. election, 3. U.S. economy and 4. Market microstructure, the bank can say with confidence that today is different than yesterday or the recent past, and the momentum factor doesn't really show that yet. As such, the thematic desk recommends to sell this factor in this more discerning risk backdrop, especially as the moves in momentum have been muted in comparison to the index sell-off and historical drawdowns of the factor. Here are some more excerpts from Miller's note. The full report is available to pro subs in the usual place. Despite the recent wobble and outright crash in Japan, momentum is still on track for the best year on record, fueled by the long leg outperforming AI/secular themes, and short leg underperforming on the higher rates environment. While momentum typically experiences very severe and sharp drawdowns every year, this has been very mild yet this year. In other words, Goldman is now officially shorting AI, and while the pain here has already been acute, it has a long way to go. At the peak in July, AI contributed to an incremental 12% returns of the S&P 500. Following the recent AI sell-off, this came down to only 3.6% YTD, but it can drop significantly more if the froth is indeed being pulled. Another reason why Goldman is going short the formerly most beloved sector, AI names currently represent close to 40% of the SPX, vs 25% when ChatGPT was released. It is still very overpriced. In case it's unclear, momentum is really just another name for AI. Shown here is the 2-month rolling correlation of momentum and AI. It is close to the highest it's ever been. There are other components which make up the basket besides AI. Momentum is correlated to strong balance sheet, megacap, and AI themes, while most short and value. In other words, 1 month after Goldman's head of research issued the warning shot, one which our readers were duly aware of, when in a must-read report he crucified the AI bubble, warning that not one transformative application has been found, the bank has officially moved to shorting said bubble. Needless to say, if Goldman is right, and the AI bubble is about to have its Wile E. Coyote moments, then watch out below. More in the full note available to pro subs. 43,72320. More market stories on Zerohedge. JP Morgan, 75% of global carry trades have been unwound. On verge of credit shock, credit card debt posts biggest drop since COVID crash as rates hit record high. Futures rebound from overnight lows as sentiment remains on edge. Show comments. Go to premium. Today's top stories. Previous. Next. Contact information plus. Suggested reading plus. Discrimination notice.